Hello, good afternoon. Yes, it's afternoon. And welcome to today's episode of Modesty's Money Masterclass. This is episode number 30. Wow, we've hit another milestone, episode number 30. So we've made it to episode number 30, and hey, congratulations to you all who have been following us, episode by episode, and who have been very much enthusiastic about what we are offering every Monday. So every Monday, this is how we make the week count. This is how we make the day count. This is how what we bring to you every single day, making sure that we educate you financially every Monday so you can start your week, with a very clear view of what you intend to achieve for the week and with your mindset in the right place and in the right mood to get you going for the week. So today we are going to be continuing on our series of personal and family protection fundamentals. Yeah, we've talked about life insurance. We've talked about income protection, and today we're going to be talking about something equally important called family income benefits. Yeah, family income benefits. Some of you might have heard about it. Some may not even have heard about it. But hey, whether or not you've heard about it, today we're going to dissect it and explain it to you, simplify it, and make sure you understand what it is. So get ready for a very loaded session of today on family income benefits. All right, so when we say family income benefits, what does family income benefits mean? Family income benefit is simply another version of life insurance, term insurance basically. So it's a term insurance policy that can provide a replacement for the salary you were earning when you were alive by the time you die. So when you die, what this policy does is that it replaces your salary. Your family, instead of receiving lump sum payment, will now be receiving fixed, tax-free, regular, monthly or annual payments based on what you have agreed with the insurance company while you were alive. So if the value of your policy is, say, £200,000, but rather than asking the insurer to give your family £200,000, you have worked out what you think your family will need to live on every month, and you have said to the insurance company, if I'm not here, do not give my family £200,000 in lump sum. Pay them £2,500 every single month until the policy runs out. So in a nutshell, that is what family income benefit is all about. It is all about replacing your income. It is another version of term policy. So it is just like normal life insurance policy without the lump sum. Now the lump sum is now replaced by fixed regular income benefits, which is why it is called family income benefit. It is replacing your income. So it's an alternative to the lump sum payment. Yeah, so, even though the policy is not the most popular death cover available at the moment in the market, it can be a good option for a cheap life insurance cheap life insurance cover. And it's something that, some young families might want to consider. Okay, so you hold it there. Just hold on until we get to the nitty-gritty of it. Now, how does family income benefit work? Like every insurance policy, family income benefit means that you have to be paying your premium. It is your premium that keeps your policy alive. If you do not pay the premium, your policy expires and there is no policy to cover you, because it's an exchange of contract between you and the insurance company. I will pay my premium. You are going to give me the cover I need. When I'm not here, you pay my family so and so amount every month. Now, payment of the premium is an exchange for for a payout of the sum assured. So you are exchanging that premium for a payout to your family in the event of death. Yeah, but in this case, it is going to be regular, either monthly or annual regular payment to your family according to your agreement with the insurance company. Now, there are two forms of premiums that you can arrange this on. You can either arrange this on the basis of a guaranteed premium or on the basis of a reviewable premium. Now, a guaranteed premium simply means that your premium will remain the same throughout the term of the policy. Throughout the term of the policy, your premium will not go up, your premium will not increase. Premium is basically, premium, by the way, is what you pay, the amount you pay for the life cover. That is what premium is, the amount you pay in exchange for the life cover. Okay, so whatever you agree to pay in the insurance company every month or every year in exchange for that life cover, that is called premium. For those who don't understand the terminology that we are using, I just want to break it down because that's the essence of doing this, making sure you understand what we are saying, what we are doing, no jargons, breaking it down to the very simplest form you would like to appreciate. Now, so you can arrange this on those two premium bases, guaranteed or reviewable. I've explained what guaranteed is. So guaranteed simply means that that premium will not go up, as well as the benefits amount. Okay, so the benefit amount remains level, the premium remains level throughout the term of the policy. So if it's a 30-year policy, for example, for the next 30 years, from the time you are in that policy, you are going to pay the same amount for that 30 years. And what if anything happens along the line within that 30 years, that amount you've agreed in year one to be paid to your family every month or every year is what is going to be paid out. Whether you died in the 20th year of that policy or you died in the second year of that policy, the same amount will be paid out to them. Okay, but the reviewable policy, the reviewable premium is one that the insurer reviews every period, say 5 or 10 years. So every 5 years or every 10 years, depending on what they have agreed or when they have agreed to review this premium or your policy. If it's every 5 years they look at this policy and they consider whether this policy is still able to meet your needs as at that time. If it's still able to meet your needs as at that time, they might decide not to adjust anything. But if they consider that policy inappropriate or inadequate for your needs at that time, they might want to review it and adjust the policy. Most times the adjustments are actually upwards. So meaning that they will actually increase the value of the benefits. And of course, when the benefit increases, your premium also increases. So it could be reviewable, it could be guaranteed premium basis. Okay, so that's the difference between guaranteed and reviewable premium. The next thing you need to know is that upon your death, the insurer will now pay your family income every month or every year, depending on the arrangement or the agreement between you and the insurance company. And then no matter how short into the policy the death occurs, for the remaining part of that policy, the insurance company will pay that agreed sum and that agreed amount every single month. So if, for example, you arranged a 30-year policy and then you die in the second year of that policy, it means for the remaining 28 years of that policy, your family will continue to receive the same amount that they have agreed for the remaining part of that policy. Flip the coin, the other side. If you died in the 28th year of that policy, it simply means that your family will only receive the benefits for the remaining 2 years of that policy. Okay? So it works both ways at whatever stage of that policy. But if you die outside of the policy, when the policy has finished, after the 30th year, your family gets nothing. And the policy expires, the policy lapses, right? So, and when the policy lapses, that's it. And one thing I need you to also bear in mind is that this policy has no cash-in value. So you cannot, after 29 years of paying the premium, say to the insurance company, look, I've been paying this for 29 years. Can I have, something on top of that? No. It's a pure life insurance policy without the lump sum. So when you are arranging a family income benefits, you need to understand how it works and manage your expectations better so that you do not go into the policy with the wrong mindset and the wrong expectation. There is no cash-in value. All right? So it is purely a life insurance cover that only pays out upon death. It is not a savings account where you're saying, okay, I will paying this 20 pounds into this insurance company every month for the next 30 years. After 30 years, you now work out what you pay and say to the insurance company, hey, I've paid you more than 10,000 pounds in the last 30 years. Can I have some of that back? No, it's not a savings account. You are paying in return for the cover that you are enjoying. So as with all life insurance products, certain deaths are not actually covered. For example, if you committed suicide, your family will get nothing, even if you have that policy in place. Or if you died as a result of drink driving, and the results and the autopsy shows that there were traces of alcohol in your system, you were over the limit, and then you were driving and you crashed and you died. Pity. That's all the insurance will have for your family, but they will not pay out. So do not start living careless life because you think you've arranged a family income benefits, and then you now go and drink and drive, and then you kill yourself because you think whatever happens, the insurance is going to take care of your family. No. You are putting your family's life. So certain deaths are also excluded from the payout of this benefit. So such death, the claim will not be tolerated and the insurance will turn it down straight away. Now, to keep your policy going, of course, you've got to keep your premiums paid and up to date. If you fail to keep up with payment of your premiums, your policy lapses and that policy expires automatically. One very important thing I also need to draw your attention to is when you are filling the form for life insurance policy, some people try to play it smart and they think that they are smart and they can outsmart the insurance company, and they now misrepresent their health conditions and misrepresent information that they are supposed to divulge to the insurance company, and they start telling them all sorts of stories that do not correlate with the reality of their health and their lifestyle. Listen to this. If you are a smoker and the insurance company asks you a question on the form, do you smoke or not? There is no point concealing the fact that you smoke. Just clearly identify and indicate that I smoke. What it does is that it helps the insurance company to analyze the risk properly and apportion the right amount of premium to you, and they know how much risk you face, you are to them, and they will either decide to accept you or reject the application if they do not want to accept you as a smoker. But in most cases, smokers are accepted, but the premiums are a little bit higher. So if that is the price you're paying for your lifestyle, but for your family to be covered, and you are happy to do that, go ahead and do that, because there is no point saying that you're not a smoker. And then when death occurs, the insurance company, upon investigation, now realize that you've been smoking. Because, for example, in this country, everybody's medical records is there available to the insurance companies because they will request access to your medical records during the underwriting process. And you will grant them that access, and they will contact your doctor and they will access your medical records. So if you've had issues with smoking in the past, and it's on your medical record, and there has been illnesses related to smoking or drinking in the past that is on your medical records, the insurance company has the right to reject that application and refuse to cover you. Or you now say you don't smoke, and then they accept you on the basis of a non-smoker, and you're paying premium on the basis of a non-smoker, and then you start smoking, and you do not inform the insurance company, look, my lifestyle has changed, I now smoke. Does it affect my policy? If it does, they will tell you. But if anything happens to you without you informing them, and they find out when the claim process is on, they will refuse to pay that policy, and they will refuse to pay that benefit to your family, and they are right to do so. So misrepresentation of facts, misrepresentation of your health situation when you are filling your life insurance policy is a very, very big offense. it can significantly affect your life policy. So for family income benefits, it applies to all life insurance policy documents. These things are very important so that you do not have an issue or have issues with the life company, or your beneficiaries have issues when it is time for them to claim. So you get it right while you are still alive, because when the claim starts happening, you will not be there to go through the stress that your family will be going through. Insurance is a business that is based on utmost good faith. That's what we call it. And a business based on utmost good faith. So both parties are expected to be transparent to each other. You're expected to be transparent to the insurance company. They're expected to be transparent to you as well. Biriki, welcome. Charity, well done. Amara, I can see you. Ebere Ndamoche, well done, sir. Stephen, thank you very much. Obi, I can see you, well done. So, you need to read and understand the terms and conditions before you commit yourself to any life insurance policy. Or better still, speak to a financial advisor. Like I've always said on this program, since I've been running this series on life cover and family protection, we don't charge you anything to assess your life cover needs. We get paid commission by the life insurance companies. And for those of us, brokers like ourselves, who have access to all the markets and to all providers, what we are recommending to you is not even based on what we are going to be paid by the insurance. It is based on what is in your own best interests. Okay, so we recommend policies to you after reviewing your situations. It's important you speak to a financial advisor or to an expert before you settle for those policies, because the cheapest policies always don't turn out to be the best policies. Okay, it's not based on price, it's not based on premium, it is simply based on what you need. Okay, now let's look at some of the factors that are affecting the premiums you pay for family income benefits. Number one is your age. Yeah, obviously, like every other insurance, life insurance policy, the older you get, the more expensive your life insurance premium is going to be. So if you have left it late, it is better late than never. So if you think you are too old to arrange a life insurance company, think about the impact of not having a life cover on your family. So you better arrange it and get what you can at that stage than not doing anything. But then if you are young, it's an opportunity for you to get much more coverage for less premium. So I encourage all the people out there who are young to go and take advantage of your age. That's the time you can arrange the cheapest insurance policy for however amount you want to arrange. It is cheaper than somebody who is older. But age is just one of it. There are certain situations where age does not always guarantee a cheaper premium. For example, a younger person who is doing a hazardous job and smoking and has a certain kind of lifestyle or underlying medical condition might end up paying more premium than an older person who doesn't smoke nor drink, or who does a less hazardous job. So it is not always a case of the older you get, the higher your premium. That is the standard principle. But there are other conditions that could also determine how much you pay in premiums. So age is one of those conditions. But in some cases, a younger person might end up paying more than somebody who is older because of maybe lifestyle and health conditions and other risk variants that the insurance company will consider. Number two factor is health. People with a pre-existing medical conditions are most likely going to pay more in premiums. Pre-existing medical conditions like diabetes or asthma and things like that, these questions get asked. Your premium will be more if you have pre-existing medical conditions. It doesn't necessarily mean that the insurance company will reject your application. It simply means that they are going to take all that into consideration before deciding the premium that you're going to pay for the coverage that they are going to give you on that policy. Now, when those medical conditions are poorly managed, it significantly affects the policy. Some insurance companies will completely refuse it. So it's important that even if you have a pre-existing medical condition, you manage it appropriately and you manage it properly. It enhances the chances of being accepted for a life cover, even though the premium might be a little bit higher than someone who hasn't got a pre-existing medical condition. So some of those applications might be rejected on the basis of poor management of the situation. Some of those applications will still be accepted. All they need to know is for you to disclose. Full disclosure, that is what the insurance company requires from you. Now, if you're drinking or if you're smoking, like your lifestyle, it can affect your premium as well. That's why the question is expressly asked in the application form, are you a smoker or a non-smoker? You indicate that. Do you drink? Do you consume alcohol? But drinking is not the problem. It is about the quantity of alcohol you consume on a regular basis. There are, minimum levels that are acceptable as normal. So when you declare how many units of alcohol you consume every week, it will help the insurance company to know whether you consume too much in a week or you consume just about normal. So alcohol consumption does not in any way mean that your premium will be high, but the level of the consumption is what the insurance company is interested in. Number 3 factor that affects your premium is the term. How long do you want the policy for? So the longer the policy, the more expensive it is, because it means that the policy will have, the insurance company will have to bear the risk for a longer period, right? Number 4 factor we want to look at is the benefit amount. How much cover do you want from the insurance company? If you want like a £300,000 worth of cover, you will pay less than somebody who wants like £500,000 worth of cover, obviously. So the amounts you want to cover for will affect that. So, and that translates to the amount you want the company to pay your family on a regular basis. Now, this is the thing. You might want your family to be receiving £5,000 every month, in income if you're no longer there until the policy expires. Fine, that's luxury for your family if you're no longer there. But the question is, do you really need them to receive that much? And if you need them to receive that much, can you afford the premium that goes? So the higher the amount of benefit you want your family to receive, the more premium you will be required to pay. Number 5 factor is your occupation. What job do you do? Some jobs and some occupations are more dangerous than the others. For example, somebody who works offshore on with a drilling company or an oil exploration company, there's a higher risk of maybe the rig exploding, or you get drowning in water, or some kind of accidents, workplace accidents happening. Or if you are working as a miner, and you are working underground, anything can happen and you could get buried underground. Now, there are certain jobs that are more risky than the others. So your occupation will also help the insurance company to analyze the level of risk of death, that's a possible death with you, before they accept that policy, or the premium that they will apportion to that policy based on their risk assessment during underwriting. So it is important that you declare what your job is and describe it and say exactly what you are doing, so that it will help them to assess that risk and not hamper your policy application. All these things are working towards if anything happens, because you will not be there to make that statement and to clarify anything. So whatever you can't clarify while you are alive, you cannot clarify it when the claims comes up. So it's very, very important that you become very clear on this before even the claim comes up. The other thing that will affect, number 6, that will affect that premium are your hobbies. And some people might be thinking, wow, hobbies, why? Why would my hobbies? Yes, the things you enjoy doing, some of them might be dangerous. There are people who are surfers. They surf on the sea, and it's a risky or hazardous hobby to have. It's interesting to them, or they might even be divers. They like diving, and when they dive, scuba divers or whatever divers, it might be their hobby, or skating on the mountains and all that. So the things you like doing, some of those things are risky. For somebody who is like, for example, a surfer, and then my hobby is singing, there is no, the level of risk in both hobbies differ a lot. For somebody who just likes singing, there is not much risk. But for somebody who likes surfing, you might surf into the deep ocean where there's a shark and you get eaten up by the shark. The insurance company has to pay. So some of those things are things that they have to consider before deciding how much premium you're paying for your policy. So when you want to, now let's talk about when you want to choose the benefits level. What do you need to consider? How much, benefits do you need to choose for your family to receive upon death? Now, as tempting as it is to lavish, your family and bless them with as much money as possible when you are no longer there, the key question is, can you afford it? If you can't afford it, why do you just want to take on something you cannot afford? Even if you can afford it at that moment, can you sustain it? So you now have to look at your income and your outgoings, which is why when we want to advise and recommend policies for people, we go through an income and expenditure analysis with them. I will ask you questions about your income and expenses. I will even ask to see your pay slip or proof of that income, because I do not want to recommend an insurance policy for you that you will struggle to sustain and maintain. Right? And once I'm sure that what you are asking me to arrange for you, you can afford it, then we can talk about the options available to you. Now, affordability is one thing. Sustainability is even more important. There is no point taking a policy that you will cancel in the next 6 months or 1 year or 2 years. It's absolutely useless. All the monies you've paid are gone and it's just rubbish. All right, because you cannot sustain it. So take something that is not only affordable but sustainable. Because at the time you are taking out that policy, maybe things are going on very well. You are receiving some kind of funds and income that are coming in left, right, and center. It may not continue like that. So you have to bear in mind something that you can sustain for a longer period. Also, sustaining it also meaning that what you are covering is necessary and the absolute necessity. So taking out a policy is meaningless if you cannot sustain it, my dear. It therefore makes absolute sense for you to consider your essential monthly expenses. So if you're arranging a family income benefit, it makes a lot of sense for you to sit down and work out, what is my monthly expenses? How much do I need to live on? How much does my family need to live on if I'm not here? And then arrange the policy to align with your monthly expenses. Because it then means that when you are no longer there, that is what your family, the minimum they need to live on is that. And life will be easier for them because all you need is to replace your income when you are no longer there, and for your family not to suffer that much of a financial loss. So you want to consider that benefit level to align with that. You also want to consider the effect of inflation. So if your family is living on £2,500 a month at this time, what if in the next 10 years you are no longer here? What £2,500 can buy now, can it buy it in the next 10 years? If you cannot buy it in the next 10 years, obviously inflation would have kicked in. So if you are worried about that, it will make sense for you to arrange your policy to be index linked. There is something we call index linked policy. That policy is tied to level of inflation. It means that every year the insurance company will review your policy in accordance with the inflation rate for that year. So if inflation goes up by 1.5%, they will increase the benefit amount by 1.5% and your premium will go up by the same level. Just to make sure that at every point where death occurs, your family is covered and the amount they are receiving can buy the amount, the value of the money at that time is equal to the value of money at the time the policy started. So if you're worried about inflation, you can consider index-linked policies. Now, some family cultures may... The other thing you also want to look at when you are arranging your family income benefit is some people look at their children and they say, okay, my last child, how old will he be before he leaves the house? And then they can arrange their policy to be in synchronization with that. Say the child is, say 5 years old now, and you reckon that by the time he's 20, he must have left the house. That's your last child. Okay? So some people now fashion or design their policies to sync with that. They will now say, okay, so I need to cater for these people for the next 15 years. In 15 years' time, this guy should be on his own. Or he's 5 years old now. I'm sure that by the time he's 25, he would have left the house, he would have established himself, and he would have been living on his own, maybe with a partner or something. So let me just arrange a 20-year policy to make sure that up to the age of 25, he's catered for. If that is how you want to arrange it, some people look at it like that. But there are certain cultures that do not actually look at things from that perspective. In some cultures, people live with their parents and their parents' house till when they are 30, 35 and all that. So if that is what you want to arrange your policy to be in line with, that's fine. If that is in agreement with your culture or your tradition or the way, David, welcome here. Or the way you see things, that's absolutely fine. But I'm just giving you ideas on what you might consider when you are arranging the term of the policy or how long you want to arrange the policy for. Okay, now some people will be asking the question, why family income benefit? Why should I arrange a family income benefit? Of what use is it to me? I have already covered those areas. I just want to point a few things out once again. Why you need to arrange your family income benefit, or of what use it is to you. First of all, it helps your beneficiaries, to cover their everyday outgoings, their everyday expenses in case of your death during the policy term. So it means that everyday living is taken care of by family income benefit. If that is what you need your family to do, that their everyday life, the bills they pay, heating, water, electricity, mortgage, rent, food, clothes, entertainment, everything, that you don't want them to worry about everyday life. Yeah, if that is what you want, you can arrange a family income benefit to take care of that in lieu of the lump sum that comes with other types of death cover. Now, though it doesn't provide lump sum payments, the family income benefit, what it does is that it covers those essential expenses and your family life continues normal, even without your presence. The other thing you also want to consider is, because the payments and the benefits are spaced out over a longer period of time and they are smaller in payments, it means that family income benefits are usually cheaper than your normal life insurance cover, because the insurance company doesn't have to pay a lump sum out in the event of death. They have to pay that money in bits, and it is spaced out over a longer period of time. So it's easier and cheaper for them to administer than paying out a lump sum benefit. Because if you consider the fact that, you die in year 1 or 6 months after arranging the policy, and then they have to cough out £500,000 to your family. If you give the insurance company the cheaper option of saying, okay, this £500,000, spread it across 28 years and pay the family, say, £1,500 every month, it's cheaper and it's spread over a longer period of time, so the premium will come in cheaper. That's one of the benefits of the family income benefits. But then let's look at the downside of the family income benefits, and we're going to end it on this downside. Sorry, I'm ending it on a downside, but it's just to balance the whole argument and the whole information. Now, family income benefit is like a decreasing term assurance. We call it DTA. Decreasing term assurance is usually a policy that is targeted at mortgages and linked to mortgages. Yeah, it means that as the year goes by, as the policy progresses, the amount of benefits that is accruable to your beneficiaries reduces. All right. So if you started the policy on 300,000, maybe by year 10, the policy and the mortgage, the outstanding mortgage is now 200,000 in year 10. The value of the policy will now be 200,000, and as the mortgage reduces, the value continues to, but your premium will remain the same. All right, so that is decreasing term assurance. Family income benefit looks like that. Why? Because if you happen to die in year 25 of your 30-year policy, it means that the insurance company will only pay you out for the remaining 5 years. So whatever is left of that policy is what they are going to pay you. So if the aim of arranging a death cover or life insurance cover is for you to get the highest level of benefit for your family in a lump sum, then family income benefits might not be suitable for you. So that's the difference. Now, the other downside again I want you to look at is, like any other term assurance policies, this policy does expire, right? So it has an expiry date. If it's a 30-year policy, after 30 years, that's it. It's finished, right? Anything happens after 30 years is none of the insurance company's business. But if you want to arrange a cover that will make sure that at any stage in your life that you're no longer here, that your family has something to fall back on, even to take care of your funeral and everything, then family income benefits may not be suitable for you. You might want to look at what we call a whole of life insurance policy, which is usually more expensive, but it serves you the purpose that you want to serve. So it all depends on what you want to achieve, which are the questions we ask when we assess life insurance policies for people and we make recommendations to them. Now, the other downside again is that the family income benefit is not suitable, for your family if they need to pay off a huge sum of money or debt immediately after you die. Say, for example, there's a mortgage to pay off, and that mortgage is paid off in lump sum. Family income benefit will not allow them to achieve that because they will be receiving the payments in bits. So if they need to pay off that loan, say £100,000 outstanding on the mortgage, they can pay it off with £2,000 monthly payments, which you have arranged. So if that is what you want your family to do, if you're no longer there, then family income benefits will not be suitable for you to do that. Because even though your family will continue to pay the mortgage with the family income benefits, there's a long-term benefit that they will be missing out on, which is the interest that would have accrued over those years that they are paying the mortgage. They would have saved themselves from paying that interest if they had paid off the mortgage with the lump sum benefit that they got. Because even though for the remaining part of that mortgage, they will be receiving that family income benefits income every month and they will pay the mortgage, it also means that as they pay the mortgage, they pay the interest. So if they are going to receive that benefit for the next 25 years, even for that 25 years, they are paying the mortgage and they are paying the interest. But if they wanted to pay off that mortgage in lump sum, family income benefit will not allow them to do that, and they would not have the benefit of having to avoid to pay those accruing interest over a longer period of time. So if paying off the mortgage is your principal priority, family income benefit will not allow your family to do that when you're gone. Okay, so these are the things you need to consider, the other side of family income benefits and when it is not suitable for you. All right, so we're going to bring it to a close here, folks. Thank you so much for being here with me. Thank you so much for staying here with me. And I hope this has been useful to you. And I hope this will trigger some, life and soul-searching questions for you about the amount of protection that you've got arranged for your family and what you have got in place if you're no longer there. If you wish to speak to me, please get in touch with me on any of my social media platforms. I'm on Facebook, I'm on LinkedIn, I'm on Twitter, I'm on Instagram, I'm even on YouTube. Okay, so let's talk and let me know how we can help. And thank you very much. Do have a wonderful day, and I'll speak to you again on Wednesday when we are talking about mortgages. We do mortgages every Wednesday, mortgage education. So if you want to learn more about mortgages, come on board on Wednesday and let's talk. And remember, my 30 lives in 30 days is still running, where every single day I come live on Facebook and I talk about different issues bordering on life, financial, business, everything that we have to talk about. Today was day 8 and I've done that this morning. So go to my Facebook page and watch the video on there for this morning where I talked about the power of social media, right? And tomorrow again, I'm going to come live again and talk to you about it. I normally do it when I go out jogging in the morning. So you might want to wake up earlier than you used to wake up to watch me live. But I normally go jogging between 9:30 and 10:30. So some of you must have been awake by then. But then we'll see you again tomorrow. Take care and God bless. Bye now.